Hi, everyone. I am Rocco Cortese. I'm the CEO and co-founder of Intersection, and this is Eric DeWeese. Eric joined us about 6 months ago. He's our senior director, leads the investment management team with our firm. And we're going to talk to you today a little bit about our company as well as how we approach acquiring real estate. But what I want to start off with is just a few thanks. I want to say thank you to Matt for having us here. I want to say thank you to Kim, to Aaron, to Nicole, and to Brittany for all the work that they're doing behind the scenes. Can we give them a hand? They are, they're hustling. They're at the desks. I see them running to make. So thank you for all the work that you're doing. I may have missed somebody else at Very Best, but I really appreciate people behind the scenes who are doing the work that they do. So what is a higher perspective on commercial real estate? We're going to talk about that today. We'll talk a little bit about our company and our investment strategy, our track record, and then some of the assets that we are currently acquiring or looking at acquiring. We don't currently have a fund. We've had funds, but right now we are only doing single venture transactions, and we're syndicating them. And as Matt alluded to, we are working together with certain joint venture partners, and they were a joint venture partner on a deal with us that really worked out well. All right, so our company, we've been around for 8 years, since 2014. My business partner and I have been working together. Actually, we started our careers in 1987 at a company called Coldwell Banker, which is now CBRE. And so we've known each other a long time, and we circle back after I returned to San Diego from the Bay Area, and it's been a pleasure to work with somebody that I've known for so long. We have 30-plus team members, 3 companies, 3 divisions. We investment management, property management, and brokerage, as well as project development and management. We're 100% owned by my business partner and I, and to date we've done $166 million in transaction volume. We are a vertically integrated company. This is a real important point. It was a real important point for my partner and I when we started the business. We wanted to be a platform, not just a deal shop. So from acquisitions up in the left-hand corner to dispositions in the right, we do everything. We can do brokerage. We do brokerage for all the business assets we own in San Diego. Whether or not there are some markets where we don't have a property management presence, but we still do the accounting. I think it's really, really important to be able to walk down the hall or walk across the floor and say, hey, did that tenant pay their rent? Or, where are we at with the monthly report? We have leasing capability, property management, as I mentioned, asset management, construction management. So we do everything all the way through disposition, and we feel like that's a value proposition for our company. We currently manage 31 properties in 7 states. We own right now 264,000 square feet of commercial real estate in San Diego, Vegas, Phoenix, and San Francisco. We have 26 third-party managed assets, industrial, office, and retail in the markets that you see here on the slide. I think what's important for me about this slide is that the properties that we manage, we don't just take on third-party management because we want the fees. We take on third-party management with clients, with investors, with relationships, and in fact, it was those relationships that really encouraged us and are right now our largest investors in all the transaction work that we've done. So a big driver of doing that work for them is being able to support them and their own investments, and they have certainly reciprocated in terms of investing with us. Look at the portfolio that we manage, and point of this slide is really that we manage a diverse set of assets. Office, industrial, retail are the 3 primary food groups that we manage, but we are only buying industrial, and this is why we only buy industrial. So when the pandemic hit, pre-pandemic, we had been buying office and retail, and what's really interesting about that asset, and no wrap on on anybody who's buying office and retail. In fact, one of the things I forgot to say is I want to compliment all of the sponsors that I've seen to date here. I mean, they have been a great group of people. I really appreciated the presentations. And it's so cool being an entrepreneur and being able to look at, that's growing his real estate company, and look at how other people are doing it. And everybody here is doing great things, interesting things. And I can tell you, as entrepreneurs, they are working very, very hard. It's great that they're here. Obviously, they're verified, which lends a lot of credibility to what they do. But some really interesting platforms that I've seen. So I'm very impressed with the group we have here, and I'm very proud to be part of it. But why industrial? So pre-pandemic, we were buying office and retail, and with a thesis that we bought in markets that we knew, where we had strong relationships. I lived in San Francisco for 20 years. I lived in LA for 6 years, and I've been in San Diego for 10 years. My partner lived in LA for 20 years, and then San Diego. So we knew the markets, and that was the strategy. And it really wasn't a great strategy, to be honest with you. I mean, we've performed very well, but I don't think there was a lot of data behind. There's not a lot of process behind what we did. So when the pandemic hit, we had to stop. Everything was quiet. And there was really no transactional work going on. And my team, I said to my team, I said, look, we need to figure out what we're going to do next. And not only what we're going to do, but why we are going to do it. So Eric wasn't with us yet, but we had another person in the role. We have a really heady investment management team. I'm going to tell, Eric's not going to like that I said this, but Eric just got his real estate planning and development degree from the Massachusetts Institute of Technology on a fellowship. So we are really proud to have, and he worked for Harrison Street, which is a $65 billion fund prior to that. So we are really proud to have him on our team. And he's taken what the team did before and really expanded upon it. But they went away for about a month. I kept on walking over and saying, hey, what are we gonna do? They're like, well, we're working on something. So finally, one day they came and they did a presentation to us, to the senior management, related to how, buying industrial. I've always felt like industrial is cap rates are over compressed and really hard to get to the asset class. I know the asset class very well. My business partner and I know. We've managed it. He's developed probably 10 million feet of industrial prior to working with us. But they, synthesizing it to this and a couple of other things that we'll talk about. Post-pandemic, the onshoring and reshoring of manufacturing in this country has created a significant amount of demand. As you can see here, U.S. manufacturing reached 12.8 million in September 2022, which is a 14-year high. And yay for America, that we're bringing jobs back to our country. So love that, and certainly generating more demand. And then e-commerce sales continue to grow. Each incremental $1 billion of e-commerce sales requires an additional 1.25 million square feet of distribution space. So in the past 3 years, we have, e-commerce has generated about 500 million square feet of industrial demand. And I like demand. I like owning something where there's demand. I like owning something where there's scarcity and demand, because then you can raise rents. And so those are some of the things that we've been able to do on the portfolio that we have. One other thing that's not on this slide is a change from the supply chain management perspective, post-pandemic, from just-in-time to just-in-case supply chain management, meaning they're holding more paper towels in the warehouses because there were none when the pandemic occurred. So it's been a shift in how supply chain managers have run their businesses, which has also created more demand. Now to our investment strategy, and I'm taking a little bit more of Eric's time than I want, so I'm going to move more quickly. 3 things. What makes us different? And if I was you, I'd want to know, why would I invest with Intersection, and really what makes you all different? Well, we have created a methodology to buying industrial real estate that I think is really unique. So first thing that smart team of ours that I mentioned earlier did is they developed an algorithm using a multivariable regression analysis to determine what markets supply chain managers are going to want to locate their warehouse needs. So Eric will get into that in more detail in a second. We also have a direct owner sourcing program. So we don't just walk into a market and slap a broker on the back and go, hey, find me a deal. We have a reciprocal collaborative arrangement with brokers. So we're getting deal flow. In fact, as you'll see, of all the assets we've acquired, we've never bought one on that's been marketed. I don't participate in that game. I don't think I add value for you in a marketed process. And if I did, I wouldn't charge a fee, an acquisition fee. So we only would charge an acquisition fee on a deal that we are able to source separately. And then finally, our vertical integration, which allows us to execute. So I'm going to give the clicker over here to Eric and let him talk about in greater detail about those about our strategy and how we add value.
Yeah, so I want to go into a little bit more detail on our investment strategy. And like Rocco mentioned, it really starts for us with market selection. And what we did in order to select the markets that we want to invest in is take a really quantitative approach to doing so. So we developed the Think tool, which Rocco mentioned. And as he mentioned, it is a weighted multivariable regression analysis. And basically what that means is we're a bunch of data nerds. But in all seriousness, what we did is we looked at 50 markets west of Denver. We took a bunch of demographic and economic data, things like population growth, blue-collar job growth, percentage of college graduates going into STEM fields, manufacturing base, things like that. And then we also looked at statistics that drive industrial demand, represent strength of industrial performance. So rental rate growth historically, as well as vacancy. And then we just compared those variables to identify the markets west of Denver that we thought were most compelling for long-term investment for industrial. And what we came up with is our power ranking here of focus markets. So we took a top-down approach to identifying our markets. Well, now how do we find our deals? As Rocco mentioned, we use what we call our direct-to-owner sourcing program. So we start, again, with data. We look at a lot of individual property-specific data, things like just property size, building coverage relative to the land, building age, the amount of debt on the property, as well as time since last sale. And we come up with a short list of 5 to 10 properties in each of our target markets. And then we work with our local market reps. And as Rocco mentioned, these are groups that we generally just have one per target market, and it's folks that we've spent the last 2 or 3 years really cultivating a relationship with. And it allows us to not just have a broker partner, but more or less an extension of our business in each of the markets where we're investing. And what that is translated to, as we send them these opportunities that we've identified, they then approach the property owners directly on our behalf, and then present unsolicited offers. So all in all, a lot of it leads nowhere, and it's a total waste of time. But sometimes it leads to a really, really compelling investment opportunity, and those are the ones that we pursue. So all of our investments to date have been done on an off-market basis like this, and all of our $70 million pipeline, which we'll get into a little bit as well, is off-market as well.
I'm just going to add one quick thing. Speaking of data nerds, our Excel model, I don't know how they did this, but Excel is a really interesting software program. It actually generates a letter of intent. So once a deal meets our parameters and we say it's a go, these guys somehow press a button and we send out an LOI. It drafts an LOI like that, pre-populates an LOI. Super cool. And we get out a number of LOIs every week. We probably I sign 3 to 5 LOIs every week for prospective deals.
And lastly, just in terms of identifying our market, then finding our transaction, the last key of our investment strategy is the vertical integration that Rocco mentioned. So we operate our properties, our investments, really cradle to grave, as we like to say. So we do everything from market selection through due diligence to transaction structuring to asset management and property management in-house, which allows us to both be more accurate in the way that we evaluate opportunities because of the data that we have in-house and our experience operating properties. It also just aligns incentives, both with us and our investors, but also internally, because the team knows that any opportunity they bring and advocate for, they're going to then have to prove out and actually run from a business plan perspective. So it's a really critical part of the way that we're set up. So what does this all translate to practically? To date, we've done $166 million of transaction volume as of this quarter. That is 9 properties across 4 different markets, totaling almost 500,000 square feet. And that represents almost $40 million of equity, which is an average of about $4.3 million per transaction. And from a return perspective, for those properties that we've realized, we've averaged just over a 30% IRR and a 2.0 equity multiple over about 3 years. And then for those that we've yet to sell, we're projecting a 45% IRR and just over a 2.1 multiple. It's noteworthy that in the last week, 2 of those that fall under that unrealized category, we just put under control to monetize. So by the end of this year, we should be hopefully adjusting those numbers upwards significantly.
On the realized side, yeah.
The unrealized, correct. And then I think the last thing is, our leverage. I mean, it's easy to look at the returns, and they're obviously really important. But for us, risk is the flip side of return. And as most folks know, a big component of real estate transaction risk is leverage. And so, unlike some groups that are using 70, 80, or even 90% leverage to do transactions, we're really proud of the fact that we've averaged 60%, which we feel is a conservative leverage level to make sure that we are mitigating risk, even though maybe perhaps we're giving up some return. So lastly, just to touch on some of our upcoming opportunities, which is why a lot of folks are here. We continue to see some really compelling opportunities as a result of our investment process that I described. So we have a single tenant transaction up in Stockton, California, which is a really interesting industrial market to us. This came as a result of our direct-to-owner sourcing program, completely off market. It's a sale leaseback to a strong manufacturing user that, as a result of being somewhat unsophisticated in the real estate realm, we think we can get at a very attractive going-in yield. We think we can be at an 8 cap going in, stabilizing through some unique value add around an 8.5 cap in a market where like-kind assets are generally trading around a 6.5. So that to us feels like a really interesting opportunity that we're pursuing on an off-market basis. We also have some investors that are more interested in just durable income as opposed to strictly value add. So we have an outdoor storage portfolio that is also a sale leaseback to a tenant that is one of the largest bulk transportation companies in the Southwest US. They're selling 7 of their assets. They'll be leasing it back for 12 years at a going-in 7.2 yield, growing at 3% a year, which we find really attractive from an income perspective. We have a multi-tenant industrial building in Las Vegas, which we like because, again, off-market, very, very low in-place rents, about 60% below market. So we think there's some great low-hanging fruit from a value-add perspective. And then similarly in Layton, which is just north of Salt Lake City, it's a little smaller of a deal, but very similar to the one in Las Vegas in that it's an off-market deal, non-sophisticated seller with a lot of low-hanging fruit. So if anyone's interested in these opportunities or just learning more about us, we will be outside at our table. We'd love to meet with you.
You got it. Okay, appreciate it.
Thanks.
Thank you all.